All right, let's be honest with each other. Tax season for a business owner, it often feels less like a season and more like an impending storm cloud, especially if you're an S corporation.
Yeah, that's putting it mildly sometimes.
That Form 1120-S can look like a secret code,
Hmm.
a labyrinth designed to confuse even the savviest entrepreneur. But what if I told you that with today's deep dive, we're not just going to navigate that maze, we're going to hand you a map to some surprising shortcuts.
Shortcuts I like the sound of.
Shortcuts that can lead to genuine tax efficiencies and, well, significant savings. Our mission today is to demystify Form 1120SS and make you, our curious and driven listener, truly well-informed without all the usual overwhelming jargon.
That's precisely our goal. We're diving far beyond just what goes where on the form. We're going straight to the heart of the instructions, extracting those crucial, actionable insights that often get overlooked.
Yeah.
We'll explore the various sections of Form 1120S and, most importantly, identify the strategies and intricate details that can directly translate into real money saved and better financial planning for your S corporation. Think of it this way. The IRS instructions for this form alone are hundreds of pages long. Consider us your expert guides, sort of cutting through that volume to give you the most impactful nuggets.
I love that, an express path to clarity. So let's unpack this from the very beginning. For anyone tuning in who might be new to this or just needs a refresh, what exactly is an S corporation and what role does Form 1120S play?
Okay, at its foundation, an S corporation is a domestic business entity that has made a special election with the IRS using a separate form. That's Form 2553.
Right.
Once that election is approved and stays in place, Form 1120S becomes its annual federal tax return. This form is essentially the S corporation's financial report card for the year. It details all its income, any gains, losses, deductions, and credits. It really paints the full financial picture.
So it's the required annual filing. Got it. But the big question for many business owners, especially those comparing entity types, is why choose an S corporation over, say, a C corporation?
Right.
What's the core financial benefit of this structure?
The primary why, really, for choosing an S corporation is to avoid what's known as double taxation.
Uh,
Let me paint a quick picture. In a C corporation, the company's profits are taxed first at the corporate level. Then, when those after-tax profits are distributed to shareholders as dividends, those dividends are taxed again at the individual shareholder level.
Two hits, ouch.
Exactly. Two layers of tax on the same income. S corporations, on the other hand, are pass-through entities. Imagine the S corp as a clear glass pipe.
Hmm.
Profits and losses flow directly through to the owner's personal income tax returns, typically documented on a Schedule K-1. The key is that they aren't taxed at the corporate level at all. Instead, the shareholders report these items on their individual Form 1040, and the income is taxed just once at their individual tax rates. This pass-through mechanism is a foundational, built-in financial advantage that attracts many businesses to the S-corp structure, allowing them to keep more of their earnings.
That's a massive distinction, clearly. Avoiding that second layer of tax can be a huge boost to a business owner's bottom line. But this S corporation election isn't set in stone, is it? Can it just disappear unexpectedly, or is it always a conscious choice to end it?
Oh, it absolutely can disappear automatically, and understanding these triggers is crucial for protecting your S-corp status and avoiding unexpected tax consequences. There are three main ways an S election can end.
Okay, what are they?
First, it terminates immediately if the corporation no longer qualifies as a small business corporation. This means things like having more than 100 shareholders, having certain ineligible types of shareholders, or issuing more than one class of stock.
Right, the basic requirements.
Exactly. If any of those conditions are met, your S status ends right away. You then have to notify the IRS on your final Form 1120S. The second way, and this is a major tax trap for many, especially if your S corporation used to be a C corporation or merged with one, it's related to passive income.
Passive income. Okay, how does that work?
Well, if, for 3 consecutive tax years, your S corporation has accumulated earnings and profits and derives more than 25% of its gross receipts from passive investment income, things like royalties, rents, dividends, interest, annuities,
Gotcha.
then your S election will terminate on the first day of the 4th tax year.
Wow, okay, delayed effect.
Right. What's even more painful is that for each of those 3 years, the corporation will also face an additional tax on its excess net passive income.
Ugh, an extra tax and you lose the status.
Precisely. This passive income rule is a prime example where being proactive about managing your income sources is a crucial strategy to boost your cash flow. Because avoiding this extra tax altogether by keeping your passive income below that 25% threshold is far, far better than having to pay it.
So it's not just about setting up the S Corp, it's about constantly monitoring its eligibility year after year. It sounds like a real long-term planning item.
Exactly. This rule directly impacts strategic business planning, particularly for S corporations that might acquire C corporations or generate substantial investment income alongside their primary business. You can't just elect S corp status and forget about it. You need to continually monitor your income mix.
Makes sense.
If you see passive income creeping up, you might consider diversifying your business activities, making distributions to reduce those accumulated earnings, or, consulting with your tax advisor early to explore options. It truly emphasizes that maintaining your S corp status is just as important as the initial election. The third way an election can end is through voluntary revocation by the shareholders.
So the owners decide.
Right. This requires the consent of shareholders holding more than 50% of the company's stock, including any non-voting shares. A revocation can specify an exact future effective date. If no date is specified, it generally becomes effective at the start of the current tax year, if filed by mid-March, or the start of the next tax year if filed later in the year. This option offers flexibility, but it absolutely demands careful planning to ensure you don't inadvertently create a larger tax burden.
That's a really comprehensive look at the what and why of S Corp and those potential pitfalls. Now let's get into the brass tacks, the practical side of filing. When is Form 1120-S actually due, and what are our options for getting it to the IRS?
Generally, Form 1120-S is due by the 15th day of the third month after your tax year ends. So if your S corporation operates on a calendar year, that typically means March 15th.
Okay, mid-March.
However, if the 15th happens to fall on a weekend or a holiday, the deadline conveniently shifts to the next business day.
Ah, good to know.
For example, for the 2024 tax year, since March 15th, 2025 is a Saturday, the actual due date shifts to Monday, March 17th, 2025.
Oh.
Corporations that are dissolved generally follow this same timeline. As for how to file, e-filing is generally required for most S corporations. The IRS strongly prefers it due to its efficiency and accuracy, and frankly, it often reduces errors.
Yeah, makes sense.
However, there are limited exceptions. For instance, if using the technology required for e-filing genuinely conflicts with your religious beliefs, your corporation can request an exemption.
Really? How does that work?
In those rare cases, you would explicitly write religious exemption at the top of page 1 of Form 1120-S and mail a paper return.
That's an interesting niche exception. So if you're not e-filing, or if you're one of the few who still paper file, where do you actually send that physical return? I'm guessing it's not a single address for everyone.
You're absolutely right. It depends on your S corporation's size and complexity. If your S corporation has total assets of less than $10 million and isn't required to file Schedule M3, that's a more detailed reconciliation schedule. You generally mail your return to Kansas City.
Yeah.
But if your total assets are $10 million or more, or if you are filing Schedule M3, regardless of asset size, then you'll send it to Ogden, Utah.
Okay, different centers for different sizes.
Exactly. And if it's a foreign corporation, there's a specific P.O. box in Ogden designated for those returns. These different processing centers help the IRS manage the sheer volume and varied types of returns they receive.
Those deadlines and filing methods are critically important because, let's face it, nobody wants penalties, right? What are the implications of missing these deadlines? How substantial can those penalties really be?
This is where timely filing becomes a very significant measure to protect your bottom line, even if your S corporation doesn't actually owe any tax. The penalties for late filing can be quite substantial and accumulate fast.
Uh-oh.
For returns on which no tax is due, the penalty is $245 for each month, or part of a month that the return is late, up to a maximum of 12 months per month. And here's the kicker that catches many off guard. This $245 is multiplied by the total number of persons who were shareholders during any part of the tax year.
Oh, wow. So for an S Corp with, say, 4 shareholders, that's almost $1,000 per month just for being late.
Exactly. Even with no tax due. If your S corporation does owe tax, the penalty's even higher.
Of course.
It's at $245 per shareholder, plus an additional 5% of the unpaid tax for each month, or part of a month, up to a maximum of 25% of the unpaid tax. Furthermore, if a return is more than 60 days late, there's a minimum penalty, which is the smaller the tax due, or $510.
Yeah.
These penalties can add up extremely fast, making diligent, timely filing an absolute must for your financial health and to avoid unnecessary costs.
Yikes.
And there are also separate penalties, often $330 per K-1, for failing to furnish scheduled K-1s to shareholders on time. So that seemingly administrative task has real financial teeth.
Wow, that really puts the urgency for getting those forms in on time. I imagine many S corporations, given this complexity, rely on paid preparers. What's their role, and is there anything special about authorizing them to speak with the IRS?
For sure, paid preparers are invaluable partners for many S corporations. They are legally required to sign the return, include their preparer tax identification number or PTIN, and provide a copy to the taxpayer.
Standard stuff.
Right. It's practical to note they can sign using a rubber stamp, mechanical device, or even computer software programs, which streamlines the process significantly. A feature many S corporations find incredibly beneficial is the paid preparer authorization. By simply checking the Yes box in the signature area of the return, you're explicitly authorizing the IRS to discuss your 2024 tax return directly with that specific preparer.
Ah, that sounds useful.
It is. It's a game changer for convenience. It means the IRS can call them to ask questions, your preparer can provide missing information, they can call the IRS to check on processing status or refund updates, and they can even respond to certain IRS notices related to simple math errors or offsets.
That sounds incredibly convenient, almost like having a dedicated liaison for those inevitable IRS follow-ups. But I'm guessing there are limits to what they can do with that authorization. They can't, for instance, accept a refund check on your behalf, right?
Precisely. It's a convenience feature, not a blanket power of attorney. This authorization does not allow your preparer to receive any refund check, bind the corporation to additional tax liability, or represent the corporation before the IRS in a broader capacity like an audit.
Got it. Limited scope.
It's limited to processing and basic inquiry resolution. It's also temporary. This authorization automatically ends no later than the due date of the next year's tax return. So it's a temporary return-specific authorization. This limited authorization is a pragmatic approach that can significantly reduce the time cost and potential headaches for you, the business owner, by streamlining communication with the IRS. It's an often overlooked way to manage your administrative burden more efficiently, indirectly saving you money.
That's a great point about the time saved being a form of financial benefit. Moving on to how the S corporation tracks its money throughout the year, let's talk about accounting methods and periods. What are the basic rules for how an S corp figures its income?
Okay, an S corporation must calculate its income using the same method of accounting it regularly uses in its internal books and records. This method, whether it's the cash method, accrual method, or another authorized method, must accurately reflect your income.
Makes sense. Consistency.
Right. There are some important rules and exceptions here. For instance, an S-corp generally cannot use the cash method of accounting if it's considered a tax shelter under specific IRS definitions. Another critical exception for many businesses relates to inventory. An accrual method is typically required for sales and purchases of inventory items.
Which is more complex, usually.
Generally, yes, unless a corporation qualifies as a small business taxpayer. This is a key point that can offer significant financial and compliance relief for smaller S-corp.
Small business taxpayer sounds like a magic phrase that could simplify things a lot. How is that defined in this context?
It absolutely can simplify things. A small business taxpayer is defined as a taxpayer that has average annual gross receipts of $30 million or less for the 3 prior tax years and is not considered a tax shelter.
30 million. Okay, that covers a lot of businesses.
It does. And this threshold is incredibly important because if your S corporation meets this definition, you are not required to capitalize costs under the complex Uniform Capitalization Rules, often called UNICAP, which we'll discuss in a moment.
Okay.
Instead, you can choose to account for inventories in a much simpler way, either treating them like non-incidental materials and supplies that you deduct when used, or by conforming your inventory accounting to your financial statements.
So what does that mean practically?
Think about the practical benefit. If you're a small online retailer, this means you might be able to deduct the cost of your inventory immediately when you buy it, rather than waiting until you sell it.
Big cash flow difference.
Huge.
Sure.
This significantly simplifies inventory accounting, reducing both administrative burden and, crucially, allowing you to deduct expenses sooner, which can optimize your cash flow. The IRS even offers streamlined, automatic consent procedures to change accounting methods for small businesses, further reducing administrative hurdles. This is a major compliance simplification and a direct financial benefit.
That's a powerful simplification and a real cash flow boost for small businesses. Beyond accounting methods, S corporations also have an accounting period. Are they all required to use a calendar year, or is there some flexibility there?
While a December 31st tax year is very common, S corporations do indeed have flexibility. They can use a natural business year, an ownership tax year, a tax year elected under Section 444, a 52-53-week tax year, or any other tax year for which a business purpose can be established with the IRS. New S corporations elect their tax year on Form 2553, and to change it later, they'd use Form 1128.
And does choosing a different year help save taxes?
Not directly. No deduction there.
Yeah.
But aligning your tax year with your natural business cycle can provide significant benefits. For example, if your business is highly seasonal, ending your tax year after your peak season can align your tax reporting with your actual financial cycles.
Ah, better planning.
Right. It can optimize cash flow planning and make tax preparation smoother. This contributes to better overall financial management, which is a form of indirect financial efficiency.
All right, let's get into the nitty-gritty that everyone's waiting for. Income and, more excitingly, deductions. This is where businesses can really find opportunities to reduce their tax liability. What are the general rules for reporting deductions on Form 1120-S?
Okay, when it comes to deductions, the crucial thing to remember is that only expenses directly related to your trade or business activity should be reported on lines 7 through 20 of Form 1120-S.
Only business stuff.
Exactly. You explicitly should not include amounts that are already reported elsewhere on the form, like on Schedule K, which flows directly to shareholders. This careful separation is key to correctly categorizing expenses and avoiding errors. Now let's dive into some specific deduction rules, starting with those Uniform Capitalization Rules, UNICAP. Generally, if you produce tangible personal property, like a film, books, or even acquire property specifically for resale, the costs associated with producing or acquiring that property must be capitalized. This means you can't deduct them immediately. You only get to deduct these costs later when the property is actually sold or disposed of.
Delayed deduction.
Right. However, and this is a truly significant opportunity for financial optimization, UNICAP doesn't apply to small business taxpayers. That $30 million gross receipts threshold we just discussed.
Ah, the magic phrase again.
Exactly. This means if your S corporation qualifies as a small business taxpayer, you can currently deduct many expenses that larger businesses would have to capitalize. This is a powerful cash flow strategy, allowing you to recognize expenses sooner, reducing your taxable income in the current year.
That's huge.
It is. There are also specific exemptions for timber and certain farming businesses, which have their own unique rules.
You just mentioned farming businesses. Are there unique rules for them under these capitalization rules?
Yes, there are. For S corporations in farming that use the cash method of accounting, the UNICAP rules don't apply to expenses for raising animals or plants with a pre-productive period of 2 years or less.
Okay.
What's even more interesting is that for plants with a pre-productive period of more than 2 years, the shareholders can elect to currently deduct these pre-productive period expenses.
The shareholders elect, not the corporation.
Correct. Because this election is made at the shareholder level, the corporation doesn't capitalize them. Instead, it reports them separately on Schedule K-1 using a specific code. This is a direct shareholder-level opportunity to reduce their personal tax burden by taking that deduction sooner.
That's very specific and incredibly useful for those in agriculture. Let's talk about compensation specifically, officer compensation and salaries. This can be a tricky area for S-Corp, especially with owner-officers. I've heard the IRS pays close attention here.
You've heard correctly. The reasonable compensation rule for officers is a key audit trigger for S corporations.
Okay, define reasonable. That sounds subjective.
It can be, but the IRS requires that payments to officers, especially owner-officers, must be treated as wages to the extent they are reasonable compensation for services rendered. This means if you're working in your S-Corp, you need to pay yourself a fair salary first before taking distributions.
Salary before distributions, got it.
Right. And fringe benefits for shareholders owning more than 2% of the corporation's stock must also be treated as wages and reported on Form W-2. For instance, health insurance premiums paid on behalf of a more than 2% shareholder are reported in Box 14 of their W-2.
And then the shareholder might deduct it personally.
Exactly. That shareholder may then be allowed to deduct those amounts on their personal tax return, Schedule 1 of Form 1040. The IRS has the authority, under Section 1366, to adjust items if they determine reasonable compensation isn't paid for services or capital. This is a critical compliance-based financial protection measure.
How so?
Underpaying an owner-officer by taking too much in distributions instead of salary can lead to the IRS reclassifying those distributions as wages, which then become subject to payroll taxes, often resulting in significant penalties and back taxes.
Ouch.
Conversely, overpaying can also be problematic. Properly determining and accounting for reasonable compensation helps you avoid these costly penalties and reclassifications, which is a direct form of saving money through meticulous compliance.
So getting that balance just right is crucial, not just for fairness, but for avoiding a potential tax bomb. What about other common deductions like rent? Are there any hidden quirks there?
For rent, you can deduct the rent paid on business property used in a trade or business activity. Pretty straightforward. However, you cannot deduct rent for a dwelling unit occupied by a shareholder for personal use. That's a clear line.
No personal use rent. Okay.
A specific quirk many don't realize is related to leased vehicles. If your S corporation leases a vehicle for 30 days or more and its fair market value on the first day of the lease exceeds certain thresholds, for example, $62,000 for cars, trucks, or vans leased after December 31st, 2023, but before January 1st, 2025.
High value leases.
Right. The deduction for lease expense may need to be reduced by an inclusion amount in gross income. This isn't a deduction, but an adjustment. And understanding this inclusion amount is vital for accurately calculating the actual deductible rent expense for those vehicles.
And what about taxes and interest expense? Are there any notable deductions or limitations there that can impact a business's tax bill?
For taxes and licenses, you could deduct those paid or incurred in the corporation's trade or business activities, such as federal import duties and federal excise and stamp taxes. Pretty standard. Interest expense gets a bit more complex. It's generally allocated by tracing the debt proceeds to specific expenditures. Prepaid interest, for instance, can generally only be deducted over the term of the debt, not all at once.
No accelerating that deduction.
Generally not. Now, there's a significant limitation that applies to many businesses, called the Business Interest Expense Limitation, Section 163J.
Okay, what's the limit?
Generally, business interest expense is limited to the sum of your business interest income, 30% of your adjusted taxable income, and any floor plan financing interest. This limitation applies at the S corporation level, and any excess interest expense that can't be deducted carries over to future years.
Carries over, okay. But does it apply to everyone?
Good question. Here's another crucial advantage for small businesses. A small business taxpayer, meeting that $30 million average annual gross receipts test and not a tax shelter, is not subject to this limitation.
There it is again. So small S Corp don't have this interest limit.
Correct. This means your small S corporation is not required to file Form 8990, the form used to calculate this limitation. This is a huge financial relief for smaller S corporations, allowing them to deduct all their qualified business interest expense without limitation. This directly impacts their bottom line and helps them manage their debt costs more effectively.
That's excellent news for smaller entities, removing a significant hurdle for deducting interest. What about other deductions and, just as importantly, the items that are not deductible? I imagine there are many hidden traps for the unwary there.
You're right, line 20 covers other deductions,
Mm-hmm.
but understanding what you cannot deduct is just as vital for compliance and avoiding costly mistakes. Let's walk through some key non-deductible items and their surprising exceptions, which can often turn into overlooked opportunities to save money.
Okay, let's hear them.
For business meals, generally, only 50% of the cost is deductible, and only if the expense isn't lavish or extravagant and an employee of the corporation is present. There's a specific rule, too, for certain workers subject to Department of Transportation hours of service limits.
So 50% is the general rule for meals.
Generally, yes. Qualified transportation fringes, like commuter highway vehicle benefits, transit passes, or qualified parking, are generally not deductible by the employer.
So if you offer parking benefits, you can't deduct that cost.
That's right. This means if your S Corp provides these, it directly increases the tax cost for the business, as you can't write them off. Membership dues in civic or professional organizations are generally deductible. However, no deduction is allowed for membership dues in any club organized for business, pleasure, recreation, or other social purposes.
So no country club dues.
Exactly. Think country clubs, golf clubs, airline clubs. These are explicitly non-deductible, so don't try to write them off. Entertainment expenses, too, are generally not deductible. This was a significant change a few years ago.
Right, I remember that. No more client golf outings as deductions.
Pretty much. However, there's an important exception that can provide a financial benefit. If the entertainment amounts are treated as compensation to the recipient and are properly reported on their W-2 for an employee or Form 1099 NEC for an independent contractor, they can be deductible by the corporation.
Ah, if it's treated as pay.
Yes, but even then there are limitations if the recipient is an officer, director, or owns more than 10% of the corporation's stock. So while general client entertainment is out, specific instances tied to compensation can still be written off.
And what about fines and penalties? I would assume those are almost always non-deductible, like a basic principle of tax law.
You'd assume correctly in most cases, but there are crucial exceptions that are definite financial insights. Generally, no deduction is allowed for fines or similar penalties paid to a government entity for violating any law.
Okay, that sounds absolute.
But it's not. Fines are deductible if they're specifically for restitution, including remediation of property.
Like cleaning up pollution.
Exactly. Or amounts paid to come into compliance with the law. Amounts paid as a result of orders or agreements where no government entity is a party. Or amounts paid for taxes due if the amount paid was specifically for restitution, remediation, or to come into compliance, and is clearly identified in the order or agreement.
Wow, so it's not a blanket ban.
Not at all. Understanding the specific circumstances for deductibility can lead to significant relief if your business unfortunately incurs such costs. It's about recovering a portion of what might seem like an unavoidable expense. Other non-deductible items include most lobbying expenses, although in-house lobbying up to $2,000 can be deductible. Also, any settlements or attorney fees related to sexual harassment or abuse are non-deductible if they are subject to a non-disclosure agreement.
Okay.
And of course, expenses allocable to tax-exempt income, like interest from certain municipal bonds, are generally non-deductible and are reported separately on Schedule K.
So even within seemingly straightforward rules, there are layers of nuance and potential opportunities to either avoid a penalty or even find a deduction. What are some other potential deductions or elections available that an S-Corp owner should be aware of?
On the more positive side, S corporations can elect to deduct a limited amount of business startup and organizational costs, maybe up to $5,000 each, and then amortize any remaining costs over a 180-month period.
So you get some immediate deduction.
Right, which can be a valuable cash flow benefit for new businesses. This election, once made, is generally irrevocable. Other deductions or elections that can be reported or passed through include certain reforestation expenditures, where a portion can be directly deducted on Schedule K and the excess amortized over 84 months.
Interesting.
There's also an election to treat expenditures for removing architectural and transportation barriers for the elderly and disabled as a current expense, Section 190.
That encourages accessibility.
It does. And for those in the creative industries, there's a powerful election under Section 181 that allows you to deduct certain costs of qualified film, television, and live theatrical productions up to $15 million for productions commencing before January 1st, 2026.
$15 million. That's substantial.
Very substantial, yes, for eligible productions. Finally, any penalty on the early withdrawal of savings incurred by the corporation is also deductible.
That's a lot to consider, highlighting the importance of a thorough review of all expenses for potential deductions and exceptions. Now, let's move to the very heart of the S corporation structure, the pass-through nature. How do income, losses, and deductions flow to shareholders, specifically via Schedule K and K1? This is where the magic happens, where the confusion begins for a lot of people.
You're right. This is where it all comes together at the individual level. The S corporation must prepare and give a Schedule K1 to each shareholder by the Form 1120S due date.
The K1, that's the key document for owners.
It is. The K1 is crucial. It's the personal report card for each shareholder, detailing their proportional share of the corporation's income, deductions, credits, and any other information they need to prepare their personal tax return. It's the essential bridge between the corporation's tax life and the shareholder's individual tax life. Now, when we talk about how that income and those losses are treated at the shareholder level, there are specialized rules that introduce critical nuances that can directly impact your personal tax bill. The first one to highlight is the at-risk limitations under Section 465.
At risk, what does that limit?
These limitations apply to you, the shareholder, not the corporation itself. Deductible net losses are limited by the amount of money you are genuinely at risk in the business. This generally means your cash contributions, the adjusted basis of property you contributed, and certain amounts borrowed for the activity that you are personally liable for.
So the corporation just provides the information, and the shareholder has to figure out if they can actually deduct the loss based on how much skin they have in the game.
Exactly. The S corporation's role is to report items of income, loss, and deduction separately for each activity so that you, as a shareholder, can correctly apply these at-risk rules on your personal tax return. This allows shareholders to optimize their individual loss deductions, preventing you from deducting more than you're truly exposed to financially. Another major area that directly impacts your personal tax bill is the passive activity limitations, Section 469.
Ah, passive activities? Heard of those?
These rules state that generally losses and credits from passive activities can only be applied against passive income or tax. They cannot be used to offset income from salaries, wages, professional fees, active business income, or portfolio income like dividends or interest.
And rental income is usually passive.
Rental activities, for example, are generally considered passive activities by default.
So if I have a passive rental loss from my S Corp, I can't use it to reduce my salary income? That sounds like a really significant limitation for many real estate investors or those with sideline rental properties. Are there any exceptions to that, especially for real estate?
This is where we find some of the biggest opportunities for real estate investors. While generally true, there's a crucial exception for real estate professionals.
Oh, how do you qualify?
A shareholder can avoid the passive activity rules for rental real estate if they meet both of these conditions. First, more than half of their personal services performed in trades or businesses were in real property trades or businesses in which they materially participated. And second, they performed more than 750 hours of services in those real property trades or businesses in which they materially participated.
That's pretty specific, 750 hours.
It is. For a married couple filing jointly, either spouse must separately meet both conditions. This is a huge rule for real estate investors as it allows them to deduct otherwise passive rental losses against their active non-passive income, potentially generating substantial tax benefits.
That could save a lot of money.
Absolutely. Beyond the real estate professional rules, an activity also isn't considered a rental activity if, for example, the average period of customer use for the property is 7 days or less. Think a short-term vacation rental.
Like Airbnb.
Could be. Or if it's 30 days or less and the corporation provides significant personal services like a hotel or maybe a bed and breakfast. Or if extraordinary personal services are provided. These exceptions can be critical because if an activity isn't considered a rental, it can then be treated as a trade or business activity, potentially opening it up to material participation, which again could allow for the deduction of losses against active income. There are also rules for when rental property is incidental to an investment or another business activity.
So understanding those definitions is key to potentially reclassifying income and losses and thus impacting your personal tax outcome. What about grouping activities? Can an S corporation combine different activities to meet the material participation rules or make things simpler?
Yes, corporations can group activities into what the IRS calls appropriate economic units. Factors considered include similarities in businesses, common control or ownership, geographical location, and reliance between activities. Once a grouping is chosen, it generally must be consistently applied in later tax years, unless the original grouping was clearly inappropriate or facts changed significantly. The IRS, however, can regroup activities if your grouping isn't an appropriate economic unit, and one of the primary purposes for your grouping was to avoid the passive activity limitations.
They can override your grouping.
They can, if they suspect abuse. There's also an important limitation on grouping. A rental activity generally cannot be grouped with a trade or business activity unless the rental activity is insubstantial relative to the business, or vice versa, or if each owner of the trade or business activity has the same proportionate ownership interest in the rental activity. Strategic grouping can indeed be a powerful tool for optimizing your tax position because it allows for the aggregation of activities for material participation tests, potentially changing otherwise passive losses into active ones. But misgrouping can lead to IRS reclassification and penalties, so it requires careful consideration. It's also important to be aware of recharacterization rules.
Recharacterization. Sounds ominous.
Well, these rules mean that certain net passive income can be recharacterized by the IRS as non-passive income. For example, income from renting substantially non-depreciable property, or from an equity-financed lending activity, or net rental income from property developed, rented, and sold within 12 months after the rental began.
Okay.
Also, rental income from property rented by the corporation to a shareholder's own trade or business can be recharacterized. The S corporation must identify these for its shareholders as it directly impacts how the shareholders treat that income on their personal returns.
This all sounds incredibly complex, with a lot of moving parts and careful balancing acts. What about portfolio income and self-charged interest? How are those handled for S Corp and their shareholders?
Portfolio income generally includes things like interest, dividends, annuities, royalties that are not derived from the ordinary course of business, and gains or losses from property held for investment.
Investment type income.
Right. This is reported separately on Schedule K and should not be reduced by related deductions, except for interest expense. For self-charged interest, which arises from loans between the S corporation and its shareholders, or even between the S corp and another pass-through entity with identical ownership, that interest income and deductions may be treated as passive.
So loans between owner and company get special treatment.
They can, yes.
Right.
The corporation must separately report this on Schedule K1 using specific codes. Proper identification and reporting of both portfolio income and self-charged interest are crucial for shareholders to correctly apply the passive activity rules, which directly affects their ability to deduct related interest or losses on their individual returns.
Now let's turn to one of the most talked about modern deductions for pass-through entities,
Yeah.
the Section 199A Qualified Business Income or QBI deduction. This one has generated a lot of buzz. How does an S corporation factor into this for its shareholders?
The QBI deduction is a significant opportunity to reduce your personal tax bill, maybe up to 20% of qualified income. And it's actually taken at the shareholder level, not the corporate level.
Okay. Shareholder takes it, but the S corp reports something.
Exactly. S corporations are required to provide all the necessary information for their shareholders to figure this deduction. This information includes qualified items of income, gain, deduction, and loss, W-2 wages, the unadjusted basis immediately after acquisition, UBIA, of qualified property, qualified publicly traded partnership, PTP items, and qualified REIT dividends. This is all passed through on Schedule K1, typically with a specific code, like Code V.
So what exactly is considered qualified income for QBI purposes, and just as important, what's excluded? Because I imagine that's where a lot of the complexity lies.
That's a great question because knowing the exclusions is absolutely vital. QBI generally excludes several key items. Income not effectively connected with a U.S. train or business, capital gains or losses, most interest income.
Unless it's business interest.
Right. Unless it's properly allocable to a trade or business, right, like from working capital, not just investment interest. Also excluded are wage income, dividends, and certain specific types of gains or losses from commodities, foreign currency, notional principal contracts, and annuities, unless directly from a trade or business. It also excludes guaranteed payments or other payments received for services to a partnership. The other major exclusion relates to what are called specified service trades or businesses, or SSTBs.
SSTBs, what are those?
These are generally excluded from the definition of a qualified trade or business, which can significantly limit or even eliminate the QBI deduction for higher income taxpayers. Examples include services in the fields of health, law, accounting, actuarial science, performing arts, consulting, athletics, financial services, and brokerage services.
So mostly professional services.
Mostly, yes. It also broadly includes any trade or business where the principal asset is the reputation or skill of one or more of its employees or owners, think endorsing products, licensing an image, or making personal appearances at events. The S corporation must separately report QBI information for all its trades or businesses, and crucially, it must also identify which of those trades or businesses are SSTBs.
Why is that identification so important?
It's absolutely critical for you, the shareholder, because you need this information to determine if you qualify for the deduction based on your individual income thresholds. Providing this accurate information to shareholders enables them to claim a potentially very large deduction on their personal returns, directly reducing their tax liability. The IRS provides an 8-question flowchart to help individuals determine what is and isn't QBI. It's a useful mental checklist. Basically, is it U.S. business income? Is it from a trade business? Is it not capital gain, dividend, certain interest? Is it not from an SSTB, unless your income is below thresholds? Every step matters.
That QBI deduction is definitely a hot topic and clearly very complex, requiring detailed reporting from the S Corp. What other important items flow through Schedule K1 that shareholders need to be aware of?
Well, there are several other items. For instance, qualified dividends. The corporation passes this information through, so shareholders can potentially apply lower tax rates on their personal returns.
Direct tax benefit there.
Right. Another crucial point is charitable contributions. There's a specific disallowance rule for certain charitable conservation contributions that exceed 2.5 times the ultimate member's relevant basis. The corporation passes the contribution amount through, but shareholders need to be aware of this specific limit on their end. Then there's Section 179 deduction recapture. If the business use of property for which a Section 179 deduction was taken drops to 50% or less before the end of the recapture period.
Like you sell it or stop using it for business.
Exactly. The corporation must provide information for shareholders to recapture that deduction. Essentially, a prior tax benefit is reversed, and the shareholder needs to account for that increase in income. A new item for 2024 to be aware of is digital assets. Corporations must indicate on their return if they had a financial interest in digital assets, meaning they are the owner of record, have an ownership stake in an account, or own a wallet holding digital assets.
So just holding crypto counts.
Owning it directly or in an account, yes. Simply holding a digital asset in a wallet or account you own, or transferring digital assets between wallets you own, generally does not require checking yes to this question on its own. It's about direct financial interest or certain transactions. Finally, there are elections to terminate the tax year. If a shareholder's entire interest in the S corporation terminates, say through a sale, a gift, a redemption, or a new stock issuance, the corporation can elect to treat the tax year as if it consisted of two separate tax years.
Split the year. Why do that?
This election, requiring consent, impacts how income or loss is allocated between the shareholders for that specific year. This can be a very valuable financial planning tool, especially if significant events like a large sale of assets or a substantial loss occurred during the year, allowing for more precise allocation and potentially optimizing individual tax outcomes. Similar elections exist for other qualifying dispositions of stock, too.
We've covered a lot about income, deductions, and how they flow to shareholders. Let's shift gears to the more internal accounting schedules, which might not be as widely known but are equally important for understanding the S corporation's financial health, particularly Schedule M2, which is fundamental for understanding shareholder distributions.
Absolutely. While Schedule L, the balance sheet, and Schedule M1, the reconciliation of income loss, are standard, they aren't always required.
Oh, when are they optional?
They aren't needed if the corporation meets certain small business thresholds. Specifically, if it answered yes to question 11 on Schedule B, indicating total receipts of less than $250,000 and total assets of less than $250,000.
Okay, really small businesses.
Right. For larger S corporations with $10 million or more in total assets, they must file Schedule M3 instead of M1, which provides a much more detailed reconciliation of income and loss between your financial statements and your tax return. But the real brain for distributions, and often the source of confusion, is Schedule M2. This schedule analyzes three key accounts: the Accumulated Adjustments Account, or AAA, Previously Taxed Income, or PTEP, and Accumulated Earnings and Profits, or AEMP. Think of them as different buckets from which distributions can be made.
Okay, let's start with the AAA. What is it, and why is it so important for S-Corp distributions, and how it impacts a shareholder's pockets?
The AAA is arguably the most critical account for an S corporation that has always been an S corp, or has no prior C corp history. It generally reflects the accumulated undistributed net income of the corporation for all its post-1982 years operating as an S corporation.
Accumulated S-Corp profits, basically.
Essentially, yes. This account is fundamental for determining the tax effect of distributions to shareholders. Here's why it matters for your financial planning. Distributions made from the AAA are generally non-taxable to shareholders, provided you have sufficient stock basis.
Tax-free distributions, that's the goal, right?
That's a primary benefit of the S-Corp structure. You can distribute profits to owners without triggering a second layer of tax, as long as you have enough in your AAA balance and sufficient stock basis. It's like getting your own money back, tax-free. The AAA is adjusted annually. It increases with your S-Corp's income, other than tax-exempt income, and certain depletion deductions. It decreases by deductible losses and expenses, non-deductible expenses other than those related to tax-exempt income, and actual distributions to shareholders.
So everything affects it.
Pretty much. If total decreases exceed total increases, it creates a net negative adjustment, which is taken into account differently for distribution purposes. Every dollar of income, loss, or expense affects this crucial bucket. Tax-exempt income and its related expenses, however, flow through a separate other adjustments account, or OAA. Now let's talk about accumulated earnings and profits, or AENP.
AENP, where does that come from?
An S corporation generally only has AENP if it was previously a C corporation or if it engaged in a tax-free reorganization with a C corporation. This is a critical distinction.
Why? What's the impact?
Because if an S corporation does have AENP, it may be liable for that excess net passive income tax we mentioned earlier if passive income gets too high. And even more importantly, distributions from AENP are generally treated as taxable dividends to shareholders, unlike distributions from the AAA.
So distributions from AENP are taxed again?
Yes, generally at dividend rates. This can be a real tax trap if not managed carefully, as it means paying a second layer of tax on distributed earnings.
So understanding which bucket your distribution is coming from is incredibly important for tax purposes. How does that ordering work? Is there a strict priority?
Yes, there's a very strict hierarchy, like a waterfall, unless specific elections are made. First, distributions reduce the AAA. These are generally non-taxable to the extent of the shareholder's stock basis.
AAA first, tax-free. Good.
Then, once the AAA is exhausted, distributions reduce the shareholder's previously taxed income, PTAP, which is an older concept for some S-Corp, and those are also generally non-taxable.
Okay, PTEP second, also tax-free.
Right. After that, distributions reduce AE&P, and these are treated as taxable dividends.
AEMP third, taxable, the trap.
Exactly. Only after all of those are exhausted do distributions reduce the other adjustments account, OAA, and finally, any remaining distributions are treated first as a return of capital reducing basis further, and then as capital gain once the shareholder's stock basis is fully exhausted. Here's where the major financial planning and tax optimization opportunities come in. The corporation can modify this order with shareholder consent.
You can change the order. How?
For instance, the corporation can elect to distribute AE&P first.
Why would you want to distribute the taxable part first?
It can be a powerful strategy for reducing future tax liabilities. Maybe shareholders prefer to pay tax on dividends now, perhaps because individual dividend tax rates are currently lower, or to proactively clear out the AE&P to avoid the excess net passive income tax in the future and protect your S-Corp status.
Ah, clean out the problem account.
Precisely. There's also an election to forego PTEP, allowing the corporation to skip that step and go straight to AE&P. These elections provide significant flexibility for managing your tax situation, making the strategic management of distributions a sophisticated way for shareholders to control their tax liability.
That's a lot of detail, but it clearly illustrates how deeply understanding these accounts and the power of these elections can really benefit a business's long-term financial health. Are there any other forms or specialized situations that S corporations might encounter that are worth a quick mention?
Yes, there are several specialized forms that indicate specific transactions or tax situations that require careful attention because they carry deeper rules or unique implications. For instance, Form 8886 is for reportable transactions, which are certain types of transactions the IRS watches closely.
Okay.
There's also Form 8938 for reporting certain foreign financial assets, and Forms 8996 and 8997 related to Qualified Opportunity Funds, or QOFs.
Opportunity zones.
Right. These forms flag specialized situations where deeper rules and potential tax implications, good or bad, apply. For example, qualified opportunity funds offer significant tax deferral and potential exclusion of capital gains, representing a powerful tax incentive if the corporation is involved in such investments. These are definitely areas where you want professional guidance.
Finally, just to put all of this into perspective, the IRS actually provides estimates for the burden of preparing these tax forms. What are those numbers for S corporations? Because it sounds like a lot of work.
The IRS does indeed provide these estimates, and they truly highlight the inherent complexity and time commitment. For Form 1120-S and all its related attachments, the average burden for all S corporations is approximately 60 hours and an estimated $4,500 in out-of-pocket costs.
60 hours.
Yeah.
And $4,500. Wow.
And that's the average. When we break it down further, smaller S corporations, those with total assets less than $10 million, average around 60 hours and $3,900. But for larger S corporations, those with assets greater than $10 million, the average burden jumps significantly to about 300 hours and an estimated $40,600.
300 hours, that's intense.
It is. The very fact that the IRS provides these burden estimates underscores the substantial time and financial commitment required for compliance. This deep dive aims to arm you with the knowledge to either navigate this process more efficiently yourself if you're doing it in-house, or to better understand and effectively work with your professional preparer. Ultimately, being well-informed can potentially reduce both your time and monetary burden, which is in itself a powerful form of boosting your financial efficiency and saving money through proactive, informed management.
This has been an incredible deep dive into Form 1120-S. It's clear that navigating the S corporation tax landscape isn't just about annual compliance. It's about strategic financial management that can truly impact your bottom line.
Absolutely.
We've highlighted so many key opportunities to optimize your financial outcome, from understanding those crucial small business taxpayer exemptions that simplify accounting and remove business interest limitations,
Huge benefits there.
to the critical nuances of reasonable compensation that protect you from audits, and the sophisticated tax planning possibilities embedded in distribution strategies, like electing to clear out accumulated earnings and profits to avoid future taxes.
That AE&P election is a big one. Given the layers of complexity and the specific elections available, understanding your S corporation's tax obligations is truly not a static annual task, but an ongoing opportunity for optimization. This knowledge empowers you to not just respond to tax season, but to proactively position your S corporation for maximum tax efficiency. So, what other proactive steps might you consider taking throughout the year, beyond just the annual filing, to ensure your S corporation is poised for even greater tax efficiency and financial health next year?
That's a fantastic, forward-thinking thought to leave you with. This isn't just about filing, it's about continuous, informed management that puts money back in your business. We encourage you to re-listen to this deep dive, apply these insights, and truly take control of your S corporation's tax strategy. Until next time, keep digging deeper.